Welcome to the deep dive. Today we're really zeroing in on ITC. We're looking at their full year financial results for fiscal 2025 ending March 31st, and also their latest Q4 numbers.
That's right. We've gone through their official press release, the investor presentation, basically the core documents they put out.
And our mission here is simple. Cut through the noise. We want to pull out the key performance indicators, the big strategic moves, and get a feel for how their different businesses are actually doing.
Especially given the, let's say, dynamic economic landscape right now.
Yeah, exactly. And I think the first impression right off the bat is one of resilience. They seem to have held up pretty well, even though they flagged a subdued demand environment and rising costs.
Definitely. Okay, so let's get into the headline numbers. For the full fiscal year, FY25, their gross revenue climbed 10.2% compared to the previous year. Pretty solid growth there.
Okay, 10.2% top line. What about profitability? The EBITDA.
So the overall EBITDA was up 2.3% year on year. But, and this is interesting, if you exclude their paper boards, paper and packaging business, that growth actually looks stronger at 4.4%.
Ah, okay. So the paper segment might be dragging that number down a bit. We should probably circle back to that.
We definitely should. And looking just at the fourth quarter, Q4, you see a similar trend. Gross revenue up 9.2%, EBITDA up 2.5%.
Or 4.2% excluding paper, following that pattern.
Precisely. Consistent revenue growth, but you can see that profitability, the margin, is under a bit more pressure.
And they mentioned why, didn't they? Input costs.
Yes, they highlighted a, quote, significant escalation in input costs, especially hit them in the second half of the year. We're talking edible oil, wheat, maida, potatoes, even cocoa.
Wow, staple ingredients.
And also core inputs like leaf tobacco and pulpwood for their other businesses. It's a widespread issue, this inflation hitting a lot of companies.
Makes sense. Still, despite those cost headwinds, they seem keen on shareholder returns. They announced a final dividend.
They did. Recommended a final dividend of 7 rupees 85 paise per share. If you add the interim dividend already paid, the total for FY25 comes to 14 rupees 35 paise per share.
Which is slightly up from last year's 13.75, right?
Correct.
Yeah.
So a modest increase, but still an increase. It signals, some confidence from the management about the overall financial health, even with the challenges.
Okay. So aside from the numbers, what about the big strategic shifts? Anything major happening structurally?
Oh, absolutely. The biggest one, no question, is the demerger of the hotels business. That's a fundamental change.
Right. That took effect on January 1st this year, 2025.
Mm.
So the hotels are now their own separate company, ITC Hotels Limited, ITCHL.
Exactly, ITCHL. And in ITC's own books now, the hotel business performance is reported under discontinued operations.
Got it. But how is that hotel business doing before the split in those first 9 months of ITC's financial year?
Actually really strong. They reported their highest ever revenue and operating profits for that 9-month period. A lot of that was driven by strong growth in RevPAR.
Rev pairs, revenue per available room, key metric for hotels.
Yeah.
So good demand, good pricing power.
Seems so. Their profit before exceptional items and tax for those 9 months was 573 crores, up significantly from 445 crores the year before.
And because of the demerger itself, the full year profit number from this discontinued operation looks massive, doesn't it?
It does. The profit after tax reported for the full year from hotels was 15,104 crores. But you need to see the asterisk there.
Ah, the asterisk. Always look for the asterisk.
It includes an exceptional gain of 15,163 crores. That's basically the accounting gain booked from the act of demerging the business. So a huge one-off boost to the bottom line, not operational profit in the usual sense.
Right, important distinction.
Right.
Okay, so hotels are spun off. What else strategically? Acquisitions seem to be a theme, particularly in FMCG.
Very much so. They've been making what they term value accretive acquisitions, really pushing their ITC Next strategy. They bought Shrestha Natural Bioproducts. That's the company behind the 24 Mantra Organics brand.
Okay, tapping into the organic trend. Makes sense.
Then there's Mother Sparsh Baby Care, getting deeper into the baby care segment.
Another growing market.
And also Ample Foods, which owns the Presuma brand, think processed meats, deli meats, and Meat Ego as well. So really strengthening their presence in processed and perhaps more premium food categories.
Looks like they're strategically plugging gaps and aiming for growth areas.
That's the idea.
Right.
And it wasn't just FMCG brands. They also made a big move in their paper segment. They acquired the pulp and paper business of Aditya Birla Real Estate Limited, which used to be Century Pulp and Paper.
Right, Century. So this wasn't just a small bolt-on. This was significant.
Definitely. They highlighted several benefits: immediate scale-up, economies of scale, better locations for sourcing and serving markets, reduced operational risks because now they have more manufacturing sites, and a more diverse portfolio within paper.
So a move to shore up a segment that, as we hinted earlier, might be facing some difficulties.
Exactly. It seems like a very deliberate attempt to strengthen that part of the business, which kind of leads us nicely into looking at the performance of the different segments that are continuing with ITC.
Okay, let's start with the big one, FMCG Others. That covers everything from ATA and biscuits to soaps and notebooks, excluding cigarettes. How did that segment do?
It showed resilience is the word they use, and it seems fair. Full year revenue was up 4.8%.
Okay.
But remember that notebook point. If you exclude the notebooks business, which faced specific pressures, the growth was actually a healthier 6.2% for the year.
Gotcha. And Q4, same story.
Pretty much. Q4 revenue up 3.7% overall, but 5.4% if you take out notebooks. So yeah, certain categories are clearly pulling the weight.
Which ones did they highlight?
They specifically mentioned Atta, their flour brand, spices, snacks, frozen snacks, dairy, premium personal wash products, home care, and Agarbati, the incense sticks. Those seem to be the growth drivers.
But notebooks struggled. Why was that?
They pointed to heightened competition in that space. Plus, the drop in paper prices actually hurt the realization for notebooks as well. It shows how specific market dynamics can impact even a giant company.
True. Any bright spots within FMCG Others?
Yes, they noted strong performance in their premium portfolio across categories and also their alternative channels. So e-commerce, modern trade outlets, those are doing well.
And the digital push seems real. I saw a number about digitally enabled sales.
Yeah, quite striking. Digitally enabled sales now make up 31% of their branded packaged foods, personal care, and Agarbatis matches turnover. That's up from just 17% back in FY20.
Wow, that's a huge shift in just 5 years. They also mentioned their EB2B platform, UN80.
Right, reaching nearly 8 lakh outlets now, so they're really leveraging tech for distribution and sales. And they didn't stand still on products either, launched over 100 new ones this year.
100 new products. Focusing on what?
Things like health and nutrition, hygiene, convenience, kind of hitting all the current consumer trends.
And they're backing this up with infrastructure too, right? Those ICMLs.
Yes, the integrated consumer goods manufacturing and logistics facilities. They've expanded to 11 locations now. The idea is to be closer to markets, improve efficiency, keep products fresh, cut down logistics costs.
Okay, comprehensive approach and FMCG Others. Now, what about the other FMCG pillar? Cigarettes.
Solid performance there. For the full year, net revenue up 7.1% and profit before interest and tax, or PBIT, up 4.9%.
And the Q4 also positive?
Q4 saw net revenue grow 6.0%, PBIT up 4.0%. They attribute this steady growth to managing their product portfolio effectively, making specific interventions in different local markets.
A micro-targeting almost.
Sort of. And also their continuous efforts to combat the illicit cigarette trade, which is a major, major headache for the legitimate industry in India.
Does the premium end perform well here too?
They highlighted good performance from their differentiated and premium offerings, yes. And interestingly, while leaf tobacco costs went up, they managed to mitigate some of that impact through changes in their product mix. Smart management there.
And there was a regulatory point mentioned too, something about track and trace.
Yes, a potentially significant development. There's been an amendment to the Central Goods and Services Tax Act, the CGST Act, that provides for a track and trace mechanism for tobacco products.
How would that help?
The hope is it will give enforcement agencies better tools to identify and crack down on illicit, non-tax-paid cigarettes. Could be a positive for the industry if implemented effectively.
Okay, interesting. Let's move to the agribusiness segment. This one looked like a standout.
Absolutely. Real strong performance here. For the full year, revenue jumped 25% and PBIT was up 18% year on year. Huge growth.
Wow. And Q4 maintained that.
It did. Q4 revenue grew 18% and PBIT growth actually accelerated to 26%. Very strong finish to the year.
What's driving that?
Primarily their leaf tobacco operations. Remember, they're a major exporter, plus their value-added agri-products, things like coffee and spices, and also rice exports.
And there was something new starting up, nicotine products.
Yes, this is one to watch. They actually commenced shipments from a new facility dedicated to nicotine and nicotine derivative products in Q4. They expect to scale this up significantly in FY26.
So potentially a whole new growth vector for the agribusiness.
Could be. And alongside the commercial side, they continue to emphasize their climate-smart agriculture initiatives. They say these programs now cover over 31 lakh acres and involve about 12 lakh farmers. So sustainability is a big part of the agri story, too.
Good point. Okay, that leaves the paperboards, paper and packaging segment. We suspected it was facing challenges earlier.
And the report confirms that.
Yeah.
It's been a tough environment. The main culprits are low-priced imports flooding the market, particularly from China and Indonesia.
Dumping, essentially.
That's the implication. Plus, domestic demand has been soft, and the cost of wood, their key raw material, has remained high. It's a difficult combination.
Leading to pressure on prices and margins, I assume.
Exactly. Subdued realization, margin pressure. That's why it was dragging down the overall EBITDA growth we saw earlier.
But were there any positives within the paper segment?
Yes, a few. Their specialty papers business, especially decor paper used in things like laminates, saw good growth. Exports were also strong. And they stress that their integrated model, controlling pulp to paper to packaging, and their investments in Industry 4.0 are helping cushion the blow somewhat.
Are they doing anything actively to fight these challenges?
They are. They mention making representations to the government for safeguard measures, think anti-dumping duties, maybe a minimum import price. They're also focusing hard on securing wood supply through plantations and partnerships, tweaking their product mix, and really tightening cost controls.
So actively managing a difficult situation. Okay, let's zoom out for a second. How does ITC frame the broader economic picture?
They acknowledge the global growth slowdown, which is pretty standard commentary now, but they highlight that India, despite some moderation in GDP growth in FY25, remains a relative bright spot, a fast-growing large economy.
Did they mention inflation's impact on consumers?
Yes, specifically food inflation. They noted it impacted consumption demand, which makes sense. If your grocery bill goes up, you might cut back elsewhere. It directly affects their FMCG sales.
And looking forward to FY26. Any optimism?
Cautious optimism, I'd say. They expect GDP growth to continue. They see potential for recovery in consumer demand, both rural and urban, continued government spending on infrastructure, and maybe, just maybe, some interest rate cuts later in the year.
All of which could create a better operating environment for them.
Could, yes. Fingers crossed. Now, beyond the financials and segments, we really should touch on their ESG performance. Sustainability is a huge part of ITC's identity.
Absolutely. And they continue to get external validation, right? The MSCI rating.
Yep. Maintained their AA rating from MSCI ESG for the 7th year running. That's the highest among global tobacco majors, which is significant. And they're also in the Dow Jones Sustainability Emerging Markets Index for the 5th year.
Those are strong credentials.
Yeah.
And their own track record on environmental stuff is quite long-standing.
Incredibly so. They reiterated being water positive for 23 years now.
Meaning they harvest more water than they consume.
Correct. Carbon positive for 20 years, sequestering more CO2 than they emit. And solid waste recycling positive for 18 years, recycling more waste than they generate. These aren't just buzzwords, it's decades of work.
Any specific recent highlights on that front?
They mentioned 9 of their units achieved the highest AWS Platinum certification for water stewardship. Renewable energy now accounts for about 52% of their total usage, which is impressive, and they continue to work on plastic neutrality. Plus, their social initiatives reach millions farmers, women empowerment programs, youth skilling. It's quite extensive.
It's a core part of their narrative. Okay, one last piece, ITC Infotech, their IT arm.
Just a quick mention, they reported broad-based growth, healthy contract signings, and they completed the acquisition of BlazeClan Technologies during the year, boosting their cloud services capabilities. Another element in their diversified portfolio.
Okay, so let's try and wrap this up. What are the key takeaways from this deep dive into ITC's latest results?
I think number one is resilience. They managed decent growth despite clear economic headwinds and cost pressures. Number two is the strategic focus on FMCG growth. The acquisitions, the innovation, the digital push, that's clearly central.
Yeah. And number three, maybe, is actively managing the challenges, especially in the paper business. They aren't just letting imports wash over them. They're fighting back.
True. And number four has to be the hotels demerger. That's a landmark strategic shift, simplifying the ITC structure and focusing on the core FMTG, agri, and paper businesses going forward.
Plus, that unwavering commitment to sustainability underlying everything.
Definitely. So resilience, strategic focus, active management, structural change, and sustainability. That sums it up pretty well.
Which brings us to our final thought for you, the listener. When you consider ITC's sheer diversity, from cigarettes and snacks to paper and agritech, combined with this really strong emphasis on both growth and sustainability, how do you think that positions them for the future?
Yeah, how might these twin pillars help them navigate the economic ups and downs, the changing consumer tastes that are surely coming, and building on those recent acquisitions and their R&D? What new areas might they target next? Where does the next wave of growth come from for a conglomerate like ITC?
Something to ponder. Definitely food for thought. Thanks for joining us on the deep dive.